Imagine walking into a market where the price of a product suddenly skyrockets. Sellers rush in to offer their goods, and the moment there are too many sellers, prices start to drop again. That simple balance between too much supply and not enough demand is the same dynamic that creates supply zones in trading. In trading, a supply zone is an area on the chart where institutional sellers have previously entered the market with large volume. When price returns to that area, those sellers often step in again, pushing the price back down. It's the mirror image of a demand zone. While demand zones represent where buying pressure dominates, supply marks where selling pressure overwhelms buyers. A supply zone typically forms right before a strong bearish move, when large institutions unload positions and drive price lower. The basic pattern looks like this: a short period of consolidation or sideways movement distribution, then a sudden breakout with a big bearish candles and a little retracement. That area of consolidation before the drop is where institutional selling took place, and where on-field sell orders often remain. When price returns there later, sellers reappear and price tends to fall again. Think of it like a ceiling. Every time price climbs into that zone, it hits resistance and gets pushed back down. Many beginners confuse supply zones with resistance levels, but there is an important difference. A resistance level is usually a single horizontal line, marking a price point where selling happened before. A supply zone is a range of prices, a block where institutional orders were placed and distributed. Resistance is what retail traders see. Supply zones are what institutions create. Here is how to spot one step by step. The first thing is to find a strong bearish impulse move, a large candle, or series of candles with little overlap. Look for the base of that move, the last bullish candle, or a small consolidation before the drop. Mark the base area, from the candles open to close or high to low, as your supply zone. When price retraces back into that area later, it often reacts strongly as institutional sellers defend their previous entries. So, why do these zones matter so much? Because institutions don't sell everything at once. Their orders are so large that they must distribute them over time. When they start selling, price drops quickly, but not all their orders get filled. So, when price retraces, they use that pullback to complete their selling. That's why price often struggles to move through these zones. They act as walls of sell orders waiting to be triggered. Now, there are two main patterns that create supply zones. The first one is a drop-based drop, or DVD. Price drops, consolidates briefly, and drops again. The second is the rally-based drop, or RBD. Price rises into a zone, pauses, and then reverses sharply downward. The RBD zones are typically reversal setup at the top of a trend. The DVD zones act as continuation patterns during ongoing downtrends. Here is a simple and effective approach. Identify a strong bearish displacement, a big drop that breaks previous structure. Find the last bullish candle or consolidation before that move. Mark that area as your supply zone. Wait for price to retrace into it. Watch for confirmation, a bearish engulfing candle, long upper wick, or liquidity sweep. Enter short, placing your stop just above the zone. Your target can be the previous swing low or the next demand zone, the opposite area where buyers are likely waiting. Supply zones are even more powerful when they align with other signals. For example, a Fibonacci retracement level like 61.8% or 78.6%, a fair value gap, overlapping the zone, a change of character after price taps the zone. When these elements overlap, the probability of a success reversal increases dramatically. Finally, not all zones are created equally. A fresh zone, untested, usually produces strong reactions because the institutional orders are still there. A used zone, retested several times, weakens over time. Most of the orders have already been absorbed. Always focus on zones that caused a major market reaction or broke structure. Those are the ones that reveal true institutional interest. Let's walk through a practical example. Imagine the Nasdaq makes a strong bullish run during the New Year session. Toward the end of the move, price consolidates briefly, forming a base, then drops sharply. That small consolidation before the fall is your rally base drop, supply zone. Later, price retraces back into that area during low volume hours. You notice bearish rejection candles forming near the same level. That's your confirmation. You enter short with a stop just above the zone and target the next demand area below. Price reacts perfectly, falling back to balance the market. Understanding supply zones changes the way you see the market. You stop asking why is price falling and start asking who's selling and where did they start. Most retail traders buy when price reaches the top of a move, exactly where institutional sellers are unloading their position. But when you identify these zones, you begin trading with the smart money and not against it. Supply and demand work together. They are like the yin and yang of the market movement. Price moves from one imbalance to another, from supply to demand and back again. When price leaves a supply zone, it's heading towards demand. When it leaves demand, it's heading towards supply. That cycle never ends. It's the rhythm of the market. Let's recap the key points. Supply zones are areas where institutional sellers enter with volume. They form before sharp bearish moves. Price revisits them, often triggers another sell-off. They are identified from the last bullish candle or base before the drop. Fresh zones are stronger, retested once weakened, combined with structure, Fibonacci or fair value gaps for confirmation. In simple terms, the supply zones are the footprints of the big players, the points on the chart where the market showed its hand. So remember, when price rises, don't get caught in the excitement. Ask yourself, are we approaching supply? Because that's where the smart sellers are waiting.